Hi, I'm Deborah Rudd, and welcome to the Hodgin Law PC International Tax Lunch. We do this every month on the last Friday of the month, noon Pacific time. Listen in online, over the phone, or watch the show later on YouTube. This month's topic is Covered Expatriates, the Exit Tax and Beyond. Covered expatriates are subject to the exit tax. There are several different ways that the exit tax is implemented. In this presentation, we'll review how the different types of assets will be taxed at the time of expatriation and in the aftermath. We'll identify assets that create harsh tax results or timing problems that lead to high tax rates, and we'll discuss steps to avoid those problems. If you have a question that isn't covered in this session, send me an email after, and I'll be happy to answer what I can. Now let's get started. Today we have a few different topics that we're going to cover. I'm going to start with an overview of expatriation because it's important to know generally what we're talking about here. Then I'm going to go into a discussion of the 4 different exit taxes that apply if you're a covered expatriate. Then we'll talk about some post-expatriation income tax issues that you can expect to arise. And lastly, we'll talk about the tax on covered gifts and bequests. First, an overview. So who is it that cares about the exit tax laws? The people this applies to are citizens and long-term residents. For citizens, if you don't know whether you're a U.S. citizen, talk to an immigration lawyer and figure that out first before you know if you even need to deal with anything related to expatriation at all. For long-term residents, this is a special term that refers to green card holders who have had that status of lawful permanent resident in 8 of the last 15 years. It's important to note that they use the word in this definition rather than for. In 1 calendar year means 1 day out of the year or more. So it's possible to meet this 8-year test if you've had your green card for 6 years and 2 days. And this is what I'm talking about. This table kind of illustrates that point. If someone got their green card, hypothetically, on December 31st, 2014, and held it all the way through January 1st, 2021, that's only 6 years and 2 days, and at that point, they've met the 8-year test because they've had the green card in 8 years. There's a little complexity that comes from tax treaties in determining whether you're a long-term resident. When you compute the 8 years, you do not count years toward that test if you're not yet a long-term resident. In other words, if you've not yet met the 8 years, and you make a treaty election to be taxed as a non-resident alien for the entire calendar year. Here's another table illustrating how that works. You'll see in the middle column, this is how it would normally be if someone had not made the treaty election. Each year counts towards the test, but let's say this person in this example made the treaty election. They were a resident of a country with a treaty with the U.S. for the entire calendar year 2016, so that year does not count. So in January 2021, they've only hit 7 years, not 8 years. So you can use treaties to toggle years that count towards the test or not. Now, when do you need to care about expatriation? Obviously, people who are just living in the U.S. as citizens and going about their lives don't need to worry about whether they've expatriated. This is something that it takes an event, an expatriation event, for you to become an expatriate. So what is an expatriate? It's a U.S. citizen or a long-term resident who terminates that status. A citizen terminates their citizenship by filing Form DS-4079 and taking an oath of renunciation. A long-term resident terminates their lawful permanent resident status by filing Form I-407 and turning in the physical green card. Note that letting the green card expire is not an act of expatriation. You still remain a U.S. taxpayer. So you could have the situation where your green card expires, meaning you don't have the same rights you would have under the immigration laws because you don't have a valid green card, but you're still on the hook as a U.S. taxpayer. So until you file the I-407, you remain a green card holder, and if you've already met the 8-year test, you remain a long-term resident. Also important to note that if you have already met the 8-year test and then you make a treaty election, that treaty election will be an expatriation event, and then you will have expatriated on the effective date of that treaty election. Now, the big topic today that we're talking about is exit tax, and exit tax specifically applies to covered expatriates. If you're not a covered expatriate, then you're not worrying about exit tax. And to determine if you're a covered expatriate, there are 3 tests and a couple exceptions that we need to look at. The 3 tests, first is the net worth test. Is your net worth $2 million or more? If it is, you're a covered expatriate. Tax liability test. Is your average tax liability for the 5 years before expatriation $178,000 or more? That's the 2022 amount. It's indexed for inflation. If the answer is yes, then you're a covered expatriate. Certification test. Did you comply with all your tax obligations for the 5 years before expatriation? If the answer is no, you're a covered expatriate. So if you fail any one of these tests, if your net worth is too high, if your tax liability is too high, or if you didn't file some of your tax returns or pay all your taxes, if you fail any one of these, then you'll be a covered expatriate. And here's a little sort of flowchart that you can use to visualize how this works. We start in the upper left corner with the certification test. The reason I start there in this diagram is because if you fail the certification test, there's no way around it. The exceptions that you can use do not save you from that. They only will exempt you from the net worth test and the tax liability test, but the certification test you have to meet no matter what. So if you don't meet the certification test, you're automatically a covered expatriate. But let's assume you meet the certification test, then you can move on to the net worth test. Check if your net worth is above $2 million. If not, you move on to the tax liability test, and you check if your prior 5 years average tax liability is low enough. And if it is, then you're a covered expatriate. And if you fail either of those net worth or tax liability tests, you can look and see if an exception applies. There are 2 potential exceptions. One is the dual citizen exception if you were born a dual citizen, and the other is if you're under age 18 and a half when you apply for expatriation. And if you can use one of those exceptions, then even if you even if you fail the net worth test or the tax liability test, then you'll be a covered expatriate. If you can't use the exceptions and you don't pass all the tests, then you're a covered expatriate. So here is the portion of the Form 8854 where you fill in the information to tell the IRS whether you meet these tests. The first line is for the tax liability test, and this is where you just fill in your tax liability amount for the 5 years before expatriation. Line 2 is net worth test. That's where you fill in your net worth. 3, 4, and 5 relate to the 2 exceptions that I discussed, and we're not going to go into detailed looking at those right now, but just know that that's what those lines are. And then line 6 is the certification test, and you just check yes or no on whether you've complied with all your tax obligations. So you go through these tests. Ultimately, you end up filling out the Form 8854 to tell the IRS the answer. And if you end up a covered expatriate, then you can expect that the exit tax rules will apply to you. And if you're not a covered expatriate, no exit tax. So if you're a covered expatriate, I say that, the consequence is exit tax, but it's a little bit more than that generally. The exit tax is actually 4 different ways that your assets, depending on the type of asset, can be taxed when you expatriate. There's also post-expatriation income tax to think about. This is not unique to covered expatriates. If you continue to earn U.S. source income or have effectively connected income, then that would continue to be subject to U.S. tax after expatriation. There's some special income tax problems that covered expatriates only would encounter. We'll talk about those. And then there's the tax on covered gifts and bequests, again for covered expatriates only. There's also a continued annual reporting requirement on Form 8854 Part 3 for eligible deferred compensation items and non-grantor trust interests, again for covered expatriates only. So most of these apply to covered expatriates, and we'll be talking specifically about those things throughout the presentation. There's some stuff that we're specifically not covering today. There's some sort of stealth exit taxes, and these do not apply only to covered expatriates. I think in a lot of cases they would apply to anyone becoming a non-resident, even if you're not an expatriate at all. For example, transfer of assets to a foreign trust is a mark-to-market event. Sometimes when a person changes from U.S. to foreign status, that causes a trust that they have to convert to a foreign trust. That could be a deemed transfer of assets into a foreign trust. So there could potentially be a mark-to-market event when someone ceases to be a U.S. person, regardless of whether they're a covered expatriate. Also, under the PFIC rules, according to some proposed regulations, if you cease to be a U.S. person, there's a deemed disposition of your PFICs. Maybe there are other rules like this somewhere throughout the code. I'm not really familiar with the entire tax code, but it's important to be aware that there are some taxes that are triggered by changing resident status, regardless if you're actually expatriating or not. We're also not going to discuss the termination of certain deferrals under Section 877 Cap A H, and this is specifically part of the exit tax rules, but there's just not time to go into it today. And lastly, there's probably lots of other important things that we're not covering today. I was sitting here making this slide thinking if I have to make a list of everything I'm not talking about today, well, that'll take all day to talk about. So just FYI, there's only so much that we can cover in an hour. All right, so let's get started with talking about the exit taxes. And as I mentioned before, there are 4 exit taxes that apply if you are a covered expatriate. The first one is for specified tax deferred accounts, and we'll talk about what that means in a few minutes. The big example for this is IRA accounts, and for these you have to pretend that there is a distribution of the full value of the account and pay taxes as if you actually received that distribution. However, there's no early distribution penalty. For deferred compensation, this is split into 2 categories, eligible or ineligible. Ineligible deferred compensation is taxed as a deemed present value lump sum distribution, and eligible deferred compensation doesn't specifically have an exit tax, but it does have a 30% withholding from all distributions that take place after expatriation. And for non-grantor trust distributions, 30% is withheld from the taxable portion of the trust distributions when paid. The 4th exit tax rule applies to all your other assets that don't fit into the first 3 categories. And for these, there is a deemed sale of all your other worldwide assets, and there's a gain or loss recognized on that pretend sale. And for this purpose, the first $767,000 of capital gain recognized on the deemed sale is exempt from tax. This is the 2022 amount, and this one is also indexed for inflation. So let's talk first about specified tax-deferred accounts. What are these? These are IRAs, Roth IRAs, Coverdell education savings accounts, health savings accounts, medical savings accounts. I think there's others as well, but these are some of the common ones. Note that these are not things like SEP or simplified retirement accounts. These are actually deferred compensation items, but you can check the definitions in the code and in the notice for sort of the full list of things that count as specified tax deferred accounts. How are these taxed? You'll have a deemed distribution on the day before expatriation, and you have to pay tax on that at your ordinary tax rates. There is, however, no early distribution penalty, and it's important to note that the gain exclusion for mark-to-market deemed sales does not apply because this is not a mark-to-market disposition. The exclusion only applies to the assets that the mark-to-market rules apply to, and these are specifically excluded from those rules. When you have the deemed distribution, you get an adjustment to your, quote, basis in the IRA or whatever account it is, so that amount isn't taxed again later when you take distributions. All right, moving on to deferred compensation. This one has two different possible tax treatments, so we'll spend a little more time on this one and talk about the difference between these two. Here I've outlined kind of a general thought process you can use for deferred compensation items if you have one. First, you need to know, is this a deferred compensation item? Second, you need to figure out if it's an eligible or ineligible deferred compensation item. Third, you need to look at how is this specific deferred compensation item taxed and what are the withholding rules. So step one, eligible or ineligible. Eligible has two requirements. First, the payer is a U.S. person or a foreign person who elects to be treated as a U.S. person for this purpose. And the covered expatriate has to give the payor Form W-8CE within 30 days of the expatriation date. Also, on Form W-8CE, you have to waive your right to reduce withholding. If you do not meet these two requirements, U.S. person and providing the W-8CE, if you fail either one of those, then the deferred comp item is ineligible. How eligible deferred compensation is taxed. So there is no exit tax at the time of expatriation for this subset of deferred compensation. The covered expatriate is a non-resident alien after expatriation, so the normal tax rules for non-resident aliens apply. You would look at Section 871. You can use treaties to change taxation of eligible deferred compensation items if you're eligible to use a treaty between the U.S. and your country of residence. You are not forced to waive the treaty benefits for taxation of income, but you are forced to waive treaty benefits for withholding. When you look at the W-8CE, you'll see that specific language. It talks about withholding only. If you have ineligible deferred compensation, then you're dealing with a deemed lump sum distribution of the present value of accrued benefits deemed received on the day before expatriation. Present value computation methods are found in Notice 2009-85, Section 5D. And just a note about other deferred compensation, including unvested benefits. You have to pretend it vested or became yours on the day before expatriation. So if you have an item like that you can't make the election for it to be eligible deferred compensation, that could potentially be a problematic asset in the case of an expatriation. To look at the withholding rules for eligible deferred compensation, as I mentioned earlier, The withholding will be 30% of any taxable payments. So when you take distributions after expatriation, you can expect a 30% withholding on the distributions. And the thing you agree to when you file the W-8CE, which gives you the eligible deferred compensation treatment, is that you agree to waive your right to reduce withholding under any tax treaty. So the withholding is always there no matter what, regardless of how much tax you actually would owe on it, even if you use a treaty. Ineligible deferred compensation, there is no withholding at the time of the deemed lump sum distribution because no payment was actually made at that time. It's just a pretend distribution that you're paying tax on. Now, if you can use a treaty, I think the withholding can be refunded. The withholding must be 30%. The covered expatriate must waive the right to reduce withholding rates by treaty in order to get this pay-as-you-go treatment for eligible deferred compensation items. Your tax liability might be zero, however. A covered expatriate doesn't waive the right to use a treaty to reduce tax liability, only withholding. So, for example, the Thailand-U.S. tax treaty says that the country of residence gets to tax the pension payments. So the result in this situation would be that a covered expatriate takes a pension distribution, 30% is withheld. They then file a Form 1040-NR and make a treaty election and claim a refund of the tax withheld. So really what this creates potentially is a timing problem because you get the money out of your account, you have to pay a withholding tax on it, and you can't get that withholding refunded until the following year. Whereas you might owe the tax in the country of your residence at a different time. So ultimately, the money side of it could work out if you're able to use a treaty, but there's some timing issues. Now, there's a special rule for certain types of deferred compensation. For exit tax purposes, you have to pretend that the substantial risk of forfeiture has lapsed for unvested items on the day before expatriation date. This rule applies for exit tax calculations, but I can't find anything that indicates that it appears to apply for the net worth test. So while you might not need to include things you don't yet own in your net worth calculation, it seems, at least in the case of deferred compensation, if you have unvested stuff, you have to treat it as if it vests on the day before expatriation. Common example of this is restricted stock units. This can be a problem if they're considered ineligible deferred compensation, but if they are a U.S. asset, you would be able to elect eligible deferred compensation treatment. And here's an example of this specifically from Notice 2009-85. Taxpayer C relinquishes citizenship December 17th, 2009. C is a covered expatriate. On December 16th, 2009, day before expatriation, C had 100 RSUs from Corporation Z that vest December 16th, 2013, and these were granted on December 16th, 2008. On December 16th, 2009, the day before expatriation, fair market value of Corporation Z stock is $30 per share. RSUs under the expatriation rules will be treated as substantially vested on December 16th, 2009, and the value of such units is includable in C's income on December 16th, 2009. So C must include $3,000 of income for unvested RSUs on his 2009 tax return because of expatriation. Now, of course, the way to solve this would be if C files W-8CE to elect that this would be eligible deferred compensation, and then he would not have this problem. It would not be $3,000 of income on the 2009 tax return. It would be instead withholding when these vest. Okay, so that wraps it up for deferred compensation. Next, moving on to non-grantor trust distributions, or non-grantor trust interests. So there's again a difference between the withholding rules and the tax rules. So here we're going to look at withholding first. This applies to distributions from all non-grantor trusts, foreign or domestic. The withholding is 30% of the taxable portion of the trust distributions that are made. And taxable portion here means do the math while pretending that the covered expatriate is still a U.S. citizen or resident. And of course, the tax rules are different from the withholding rules. The tax rules, the covered expatriate's a non-resident alien, compute tax liability on the trust distribution using Section 871. And if the trust distribution contains U.S. source income, then the beneficiary is taxed under Section 871. If the trust distribution is foreign source income, beneficiary has no tax liability under 871. So you have a situation, again, where there could be withholding required, but no tax liability. So in that case, again, the answer is file Form 1040-NR to claim the tax refunds. Okay, now moving on to the mark-to-market deemed sale. And this is, I think, what most people are thinking of when they're talking about the exit tax, the pretend sale. This is where you pretend that you sold everything else that's not one of the first three types of assets. It's not deferred compensation, not specified tax deferred accounts, and not non-grantor trust interests. Everything else you own, you pretend you sold it, recognize gain or loss, and pay tax on any gains above a threshold exemption amount. So when you're operating under the mark-to-market rules, the things that you need to look at are, first, there's a let's pretend disposition. You're not actually selling your stuff, you're just pretending that you are. There's a special basis rule for green card holders where they get a step up in basis for certain assets. You have to look at the gain exemption amount and how to allocate that gain exemption among your assets. And lastly, there are some tax payment deferral rules. The mark-to-market rules apply to everything you own in the entire world except the stuff with special rules that we already just covered: specified tax deferred accounts, deferred compensation, and beneficial interests in non-grantor trusts. So what do they mean by everything? Basically, you just answer the question, would it be includable in your gross estate if you died on the day before expatriating? Plus, are you a beneficiary of a trust that's not part of your gross estate? Include the value of that beneficial interest too. What's the sale price? You have to pretend you sold at fair market value, and you use estate tax principles to determine fair market value. There are some special modifications to estate tax principles in Notice 2009-85, Section 3A. Beneficial interests in trusts are valued using gift tax principles, and so are the value of life insurance policies determined under gift tax rules as well. And what do you use as basis? Your basis is your basis. Basically, whatever normal rules apply to computing your adjusted basis, you use those rules here too. For green card holders, they can elect basis to be fair market value of assets they owned on the first day they became a resident alien, not just a green card holder. But this rule specifically does not apply to U.S. real property interests. So how do losses and carry forwards get handled? Losses are recognized because it is a pretend sale. So just like you recognize gains, you would get losses, but you don't have to worry about the wash sale rules for the exit tax. And there's no specific guidance on this because we're dealing in the world of pretending there's a sale. but we take the position that a sale is a sale for tax purposes, even a pretend sale, deemed transactions, and this would, of course, unlock suspended passive activity losses in the same way that a real sale would. And also you can use NOLs if you have them. Now, when you have this pretend sale, gain or loss is recognized because of Section 877 Cap A. The character of the gain and loss is determined by the regular rules of the Internal Revenue Code, so some of it will go into your capital gain bucket, some of it will go into other buckets. And the first $767,000 of gain is tax-free for 2022 expatriations. If you are dealing with a client who expatriated in 2021, then the number is $744,000. It increases each year for inflation. And then lastly, you would need to allocate the exclusion pro rata across all gain items. You cannot pick and choose which items to apply it to. So like if there was an asset with a higher tax rate, you wouldn't be able to just shove all the exclusion onto that item. It does need to be proportionally assigned to all of the gains that you have. For mark-to-market assets specifically, there is an option for tax payment deferral. To achieve this, you need to do some paperwork, post security, and you have to pay interest on all the unpaid tax liability. This is not allowed on the tax liability triggered by specified tax deferred accounts, deferred compensation, trust distributions, etc. Personally, I've actually never handled one of these. I've never had a client who elected the tax deferral, so I don't actually have a lot to say about this, just that it exists and that there's a lot of hoops to jump through to achieve this. Now, after you expatriate, you file your final year. Well, it might not be your final, but you file your expatriation year tax return, but you still have some things hanging around in the U.S. generating income for you, like maybe you have some pension accounts or retirement savings accounts from when you were working in the U.S. You're going to encounter post-expatriation income tax issues, certainly with the U.S., and then I'm also going to highlight a couple areas where foreign assets can cause some issues for you. So after you expatriate, you're a non-resident alien, and the things that are taxed for non-resident alien individuals are income effectively connected with a U.S. trade or business and U.S. source income that is not effectively connected with the U.S. trade or business. These are taxed under the normal rules, even if you're an expatriate, even if you're a covered expatriate. Effectively connected income gets taxed at graduated income tax rates, and you get to take deductions. Income that's not effectively connected gets a 30% flat rate on gross income, and you do not get to take deductions. But on the not effectively connected income, you may be able to elect treaty rates if you're eligible. Now, if you had to pay exit tax, if you're a covered expatriate, there are some basis adjustments that result from that. So if you had mark-to-market property, then you would increase your basis for the gains recognized. If you had ineligible deferred compensation, where you had a deemed lump sum distribution, that deemed distribution amount becomes your basis, and you're taxed like it's an annuity on future distributions. Same thing for specified tax deferred accounts. You had that deemed lump sum distribution, so that amount becomes your basis, and moving forward, future distributions are taxed like an annuity. Now, one issue that commonly causes issues is if you own foreign real estate at the time of expatriation, and if it is an appreciated asset, so if it has increased in value. You'll have to do the deemed sale at time of expatriation because the deemed sale applies to all your worldwide assets. and then you still own the property, maybe it's your home in another country, and let's say you sell it later, your basis will not get stepped up in the foreign country for the exit tax you paid in the US, obviously. So you won't owe any US taxes on the sale of the property, but you might owe foreign taxes. And when you owe those foreign taxes, it seems incredibly unlikely that you would be able to take a foreign tax credit for the exit tax you paid in the US in a previous year. I haven't yet encountered any situations where someone was able to take a tax credit for that. So this is a problematic issue, and one that often can be dealt with by pre-planning. Sometimes people choose to actually sell the property. Sometimes someone is moving to a foreign country, so they wait to buy the property until just before they move and just before they expatriate, so that their basis is equal to fair market value or very close, so they don't have any gains, so they don't end up with exit tax on that specific asset. But in any case, this one is one that can certainly cause some problems. Another issue is foreign pensions. Because they're not U.S. payors, almost certainly they're going to be ineligible deferred compensation under the exit tax rules. That means there's a deemed distribution of the present value of the asset. Then later, when actual distributions take place, they paid the U.S. exit tax on the deemed lump sum distribution, but again, it'll be highly unlikely that there's any foreign tax credit available for the exit tax on a pretend distribution, and this can create a very high overall rate of tax. Now, there is a possible remedy to this solution, at least in a lot of cases, and that is Section 877 Cap A, I think it's D5, I believe. That might be wrong, but it's somewhere in subsection D, or paragraph D, I mean, where it says that if you had one of these types of assets and you can attribute contributions and some of the investment growth to a time period before you were a U.S. citizen or resident, then you don't have to include the amount attributable to that period in your U.S. tax. So those later actual, so the exit tax amount that you compute would not include the amounts that were attributable to a period when you were not a U.S. citizen or resident. So in a lot of cases, that helps either entirely solve the problem or at least makes it a lot less bad for the person who's expatriating. So that's a really important rule. It's not actually on the slide here, but that one is important to know about. Next, let's move on to talk about the tax on covered gifts and bequests. So I've worked with a number of people who are planning for their expatriation, and I calculate their net worth, and we see that they'll be covered, and we calculate their exit tax, and we might even discuss ways to avoid the exit tax, or at least minimize it. But in some cases, a client will say, you know what, I don't mind being covered because if I'm covered, my exit tax will be zero, or if I'm covered, my exit tax will be a low amount, and I'm perfectly fine with just paying that and moving on with my life. That's when we start to have the conversation about covered gifts and bequests. Because if it's not the exit tax itself that makes you want to avoid covered expatriate status, then in a lot of cases, the tax on covered gifts and bequests will. And this is it's sort of a reverse of the normal estate tax rules, where the recipient ends up paying the tax if they receive things from a covered expatriate. Normally, it's the person giving away the assets who pays the U.S. tax. In this case, if you have a U.S. recipient receiving the assets, they'll pay the tax. And it's 40%, so it's pretty high. These are the rules under Section 2801, and the target that they're looking at is a covered gift or bequest. This goes from a covered expatriate to a U.S. recipient. The goal of these rules is to make expatriation tax neutral, and what is meant by that is, if you look at the right-hand side of the screen, this is how the estate tax normally works. Let's say you have a U.S. citizen with $100, obviously a much higher amount because of the unified credit, but let's pretend the unified credit doesn't exist just for a second. The U.S. citizen has $100. They'll pay an estate tax of 40% to the IRS. The rest of it goes to the U.S. recipient. In a situation where a covered expatriate, so someone who's no longer a U.S. person, is leaving assets to a U.S. recipient, they will pay that money to the U.S. recipient, and the U.S. recipient is responsible for paying the 40% to the IRS. So either way, the U.S. recipient gets the same amount, the IRS gets the same amount. It's just that the person responsible for paying the tax is a different party. So how do you know when this tax applies to you? Can break it down basically into an equation. This is covered expatriate plus U.S. recipient plus covered gift or bequest. If you have all of those elements, then you will be dealing with a Section 2801 tax liability. So let's take a look at what is meant by each of those terms in this context. Covered expatriate will be the first one that we look at. For Section 2801, covered expatriate has the same definition as used for income tax purposes from Section 877 Cap A, but not if the covered expatriate became a U.S. resident or citizen again. In that case, the Section 2801 rules would not apply. And you use the estate or gift tax definition of resident, which is a domicile test, not a count the days or do you have a green card test. And what is U.S. domicile? There's a couple court cases here that deal with that if you want to look at them, but basically the answer is at the bottom of the page. This is a person who acquires a domicile in a place by living there, even for a brief period of time, with no definite present intention of later removing therefrom. So in other words, it's where do you live and do you intend to stay there? So, of course, one idea is if you're a covered expatriate and you need to leave things to your heirs and you want to make sure that they get as much of it as possible and the government gets as little of it as possible, one potential option is to reestablish U.S. domicile. Obviously, in a lot of cases, if you're expatriating, that might not be your goal, but this is potentially a solution. So if you look at the left side of the screen, you see the Section 2801 tax. You have a covered expatriate with $3 million, giving a U.S. recipient all of that. But of course, the U.S. recipient has to pay 40% of it to the IRS, so they're only left with $1.8 million. But if the covered expatriate moves back to the U.S. and establishes domicile here again, then in that case, when they give that $3 million to their U.S. heir, they will be able to use the unified credit, so the IRS won't get any of it, and the entire $3 million can pass to the U.S. recipient. So potentially this is a way around the problem, but obviously if you're expatriating from the U.S., you might not be planning to move back, so it might not be a practical solution in all cases. And the second element that we're going to look at is a U.S. recipient. And this is defined to be a few different things in the proposed regulations. The most obvious is a U.S. citizen or resident. It's also domestic trusts, foreign trusts that elect domestic trust status for this purpose, and U.S. beneficiaries of foreign trusts, U.S. owners of domestic entities, and this last line is left undefined. Now, one of the questions I've gotten many times is, oh, I can't pass things to my kids tax-free. What if I give them to my non-resident friend and my friend gives them to my kids? Then we avoid the Section 2801 tax. Well, on paper, maybe that works, but the IRS is really looking at the substance of a transaction. So you might want to tell the IRS that you or your kid received the money from an unrelated person when really it came from a covered expatriate. And I think there's even something specifically in the code about this under Section 2801. But in other words, something to watch out for, because the IRS truly is looking for where did the money actually come from. Okay, the last element, we've looked at who's a covered expatriate for this purpose, who's a U.S. recipient. Lastly, what is a covered gift or bequest? Because you have to have all three for the Section 2801 tax to apply. And a covered gift or bequest is essentially anything from a covered expatriate, but it has to be a gift in order to be a covered gift. Usual definition of gift applies. Covered gifts and bequests mean any transfers coming from a covered expatriate directly or indirectly, actually to anyone. It's only when a covered gift or bequest touches a U.S. recipient that it spawns a Section 2801 tax. You can't use some of the exceptions to claim that a gift is not a gift and therefore it can't be a covered gift. There are some under the normal gift tax rules where you don't have to claim them as gifts, but these specific ones do not work for the Section 2801 tax. Transfers of intangibles by non-residents, payments of school and medical expenses, and a few other less common exceptions. And there are, thankfully, some exceptions that do work. Fair market value transactions, like a sale, those aren't gifts. You also get to still use the annual small gift exclusion. I think it's 15 or 16,000, somewhere around there right now. An amount smaller than that threshold still is a covered gift, but the tax does not apply to amounts below that threshold. Gifts that are otherwise subject to the gift tax and are reported on a timely gift tax return, you wouldn't have gotten out of those anyway. And gifts made while the covered expatriate is a U.S. resident. And some more exceptions that work: marital deduction transfers to U.S. citizen spouses, QDOTs for bequests to non-citizen spouses, gifts to non-citizen spouses under the large annual gift exclusion. So, for example, if you have green card holder spouse living abroad, and then lastly, of course, charitable transfers. So what's the actual Section 2801 tax? Let's say you've met all three of these elements. You're a covered expatriate, and you're making a covered gift or bequest to a U.S. recipient. What do you do? The form you would report this on is Form 708, but at the moment it has still not yet been published, and supposedly it will be published when the proposed regulations are final. No filing requirement until the regulations are published, and no payment of tax required until the regulations are published. A lot of people have asked me, oh, does that mean I can, do my expatriation planning as if this is not going to be an issue I have to deal with? Well, just from a being generally careful standpoint, I wouldn't necessarily recommend that. And if you do decide to go that route, you're definitely kind of taking on the risk that before your plan is implemented, that these requirements could come into effect, because they're certainly on the books, the laws exist, and we're just waiting for the IRS to carry them out. In terms of the tax liability for Section 2801 tax, you look at the fair market value of the covered gift or bequest received minus the annual exclusion amount, multiply that by the highest estate or gift tax rate in effect when the covered gift or bequest was received, and you can take a credit for foreign gift or estate taxes paid on the covered gift or bequest. That brings us to the end of this presentation and just kind of a few key takeaways to leave you with. The exit tax is actually 4 different sets of rules that apply to different types of assets of covered expatriates. So the deemed sale that everyone thinks of is just one part of it, and a lot of the rest of it has to do with retirement accounts because a lot of the specified tax deferred accounts and deferred compensation has to do with retirement savings. So the big issue to look at is retirement accounts when you're doing your expatriation planning. Exit tax may not, and in most cases probably does not qualify for foreign tax credits where you're living in another country. So certain assets can have bad double taxation problems, and if you're planning to expatriate, you really specifically want to kind of zero in on those. If you can't avoid being a covered expatriate altogether, you definitely want to plan very carefully for the assets that will have bad double taxation problems where you're paying exit tax and then more taxes after expatriation, so you end up with a very high overall rate of tax. So you really want to focus on those. And then even if you're a covered expatriate and your exit tax is 0 or not very high, the Section 2801 tax on covered gifts and bequests may make the covered expatriate status undesirable. Really depends case to case. Like I've worked with people who their entire families, anyone they would want to give or leave anything to is in another country, and they're planning to move there, and that's kind of where they're gonna live during their retirement period. And so they don't mind being covered as much because they don't have this looming over them for future transfers. They're just not going to have to worry about it. But a lot of people do have to worry about it, especially a lot of times U.S. citizens who are expatriating just in general tend to have more, family connections as a general rule in the U.S. So this is more of a concern in those cases. And then lastly, often but not always, tax planning prior to expatriation can eliminate or minimize these types of problems. So this is just kind of a look before you leap warning. It's a good idea to fully understand not just the immediate impact, not just the exit tax, but also the long-term impact on your taxes that expatriation will have. With that, I'm going to leave you with a list of resources, just some places that I use to put together this information and places that I consult frequently when I'm looking at the expatriation rules and working with clients. And a quick disclaimer, this presentation is not legal or tax advice. Cannot use it to avoid penalties. Please, if you need help, hire someone to help you. And then lastly, here are my contact information. If you have any questions that didn't get answered during the presentation, feel free to reach out to me and I will try to answer what I can. So thanks everybody for participating. I encourage you to email us if you had a question that wasn't answered during the session. Next month's session will be March 25th, 2022, presented by Phil Hodgen. The topic will be Introduction to Form 5472. If you're not already on the mailing list, please sign up to get the announcement emails about upcoming international tax lodge topics and go to hodgen.com to do this. If you're already on the mailing list, and you probably are because you're listening to this, please tell your friends. See you next month. Bye.